All right, we're ready to get this ball rolling. We're here at our office at Hughes and Associates, and we got Kurt Brown standing by to give us our quarterly market and economic update. Weston and I are here in the office, and want to welcome everybody that is joining us on the webinar. And hopefully all those that are tuning in Iron County are dealing with the flooding issues really well. Hopefully we haven't got anybody that is dealing with some of the adverse effects of the flooding in the last couple of weeks. But if so, come talk to us. We'll maybe there's even some things on tax loss, disaster recovery things we can talk about. So, but let's go ahead and get started. We'll turn the time over to Kurt, and we'll jump into today's economic update.
All right. Now, I was on mute. I was talking, I was on mute. You'd think after like all these years on Zoom, I would have that figured out by now. But David, Weston, good morning, guys. Thanks so much for having me as part of the call. It's always fun to be with you guys. And I want to echo what David said. I hope everybody's doing okay out there. We've got clients all over the place, including in Northern California and these fires and stuff. And it's always a scary time of year. So hope everybody's good out there. I know this COVID stuff continues to impact a lot of people as well. People have lost loved ones and yeah, just hope things are good for you. Really appreciate you guys and your business and being trusted clients. And we like to do this because it's so difficult to get really objective sort of economic and market news. We're in this world now where all the media has some kind of bias and there's a spin machine around everything. Like literally anything now is caught up. It's either politicized or spun or whatever. So we constantly keep our investment committee here. We have a 7-person investment committee. We manage assets for about 1,500 high net worth families. It's about $5.5 billion of clients' retirement money and invested assets. And we like to keep at any time sort of a running core sort of pros and cons list about what is going on in the economy and what is going on in the market, but just through a raw lens of information and insight. We're lucky because we get to talk to so many high net worth families and business owners. So we're kind of getting a lot of color from what's going on sort of on Main Street. But then we also talk to a lot of fund managers and hear what they're seeing inside of corporate America, inside, balance sheets and income statements of the world's biggest and fastest growing companies. So we get a lot of information and some of it is really interesting. So in the next couple of minutes, I want to share some of that with you just to provide you with some insights around what's kind of really going on out there away from the spin machine. So let's keep it simple and knock out kind of what we view is really good that's going on out there. Kind of the lifeblood of corporate America and GDP is the earnings of all of our companies. And it surprises people on a regular basis that earnings are making new all-time highs by a lot, not by a little bit. When the world sort of stopped here in COVID, it also stopped back here in the financial crisis. But look at this explosion out of COVID. I mean, the recovery coming out is unlike what anybody anticipated. A year ago, I didn't hear anybody talking about what's happening right now in terms of earnings growth. That is real. That is legitimate, economic growth there. You talk about profit margins, right? And beating expectations. We've never had so many companies beating analyst expectations. So you've got all these Wall Street analysts that are constantly talking to these companies and trying to figure out how much they think they're going to make in the next quarter. And 88% of companies last quarter beat those estimates. So not only has it been really good, it's been way better than expected. And markets and the investment community love that combination, love that recipe. Profit margins have never been so high in this country. So not only are we making a lot of money, but then on top of it, the efficiency with which the companies are running have never been so high as well. And for my entire career, I've been hearing that and I'm going on my 30th year in the business. I've been hearing profit margins cannot keep growing. Well, this right here is one of the chief reasons why profit margins keep growing. Technology has changed everything. I mean, in 86, you had to have 8 employees for every $1 million of sales. Today it's 2, right? So we get a lot more done at the corporate level. It's amazing what I can get done in I have 40 employees here. Even 10 or 12 years ago, I would have had to have 60 employees. It's incredible what we can do with technology and software now inside of our businesses. Anybody that was out traveling with their families this summer knows travel is fully back. I mean, airplanes, hotels. So the blue line is the 20-year average of hotel occupancy. So here in the late summer, we're just about back to where the average 20-year hotel occupancy has been. That's a big deal. You think about where we came from, even just right at the beginning of the year. Things are really moving. A lot more people have jobs. This jobs picture is really incredible. There have never, ever been so many job openings in this country. By the way, this updated number is now over 10 million. So that's really something. There has never been so many jobs posted as open. So you now have 8 million people in this country that are taking some kind of unemployment claim and 10 million job openings. It's one of the reasons we're having such trouble with the hiring. Personal savings rates continue to be huge. I want to kind of go through a couple other things here that are really, really positive. There's still an incredible amount of cash on the sidelines. We've got, 4.6 trillion sitting in money market funds now. That's down from about 6 trillion at the peak last year. That still is right near the all-time high in terms of the amount of cash sitting on the sidelines compared to the size of our economy. And this number is even more mind-blowing. We now have $17 trillion sitting in just US checking accounts, checking and savings accounts. That's up 33% in just 2 years. The banks are so flush with cash, they don't know what to do with them. And the Goldilocks part of that is they're not yet lending to weak borrowers. And that's really what got us in trouble for the financial crisis, right? We're not seeing hardly any of that yet. So that's a really, really good thing as well. One of the reasons that the borrowing picture is so much better in this country is that households have a lot of liquid assets compared to their liabilities. This is primarily what you have in the bank account, your checking account, savings account, money market, or it's in your retirement plan or your, investment portfolios and whatnot. Before the financial crisis, look what this was doing. Household net worths didn't have any liquidity. They didn't have cash around. It was all invested in something. This is back when people were just buying their 3rd, 4th, 5th home. It was all invested somewhere. Today is exactly the opposite, right? So we just went in, these gray lines are recessions. We did something that has never been done before. And that is liquidity went up and way up during a recession. So households are in really, really good position. Now, there's always that group in the lower wage income or unemployed group that is really having a hard time. But in most of the country, you're seeing households with a lot of liquidity. This is total revolving credit back 40 years. We've never seen such a reduction in revolving credit. The only reason we had this was because of the financial crisis and the banks could not lend. Today, the banks are flush with cash and households don't want to borrow. That's very, very rare to have a circumstance where we have a lot of liquidity, a lot of home equity, and yet people don't want to borrow money. That's really, really an impressive data point around how strong household balance sheets are right now. Debt delinquencies. This goes back to the beginning of the pandemic. You're seeing almost no delinquencies in any kind of debt out there, right? Auto delinquencies, almost none. Mortgage delinquencies, credit card delinquencies, almost none. Now, granted, you're going to see a couple of these blip up, probably these two, when all of the CARES Act stimulus gets killed off, right? But it's probably not even going to be back to normal. So again, the debt picture in this country, really good. This is the strangest chart I've possibly ever seen in my career because it is the exact opposite of what every finance textbook will ever teach you, okay? All the chart is saying is that as Americans get more disposable income, they have more money left after their bills, right? There is a direct one-to-one correlation. If Americans make more money, they spend more money, right? We know this. Make more, spend more. Okay. This is like basically the first time ever that we have data points that are exactly the opposite. Make more, spend less. Okay, so a lot of what you see on TV or read on social media is saying, oh my gosh, the housing market's in a bubble. The stock market is in a bubble. Does this look like bubble-like behavior? It's precisely the opposite of bubble-like behavior. You are not seeing individuals with money acting aggressive and risky with their money. The last 8 slides I've shown you reiterates that the average American is still being defensive and conservative with their money. That's really healthy. Now, I'm not saying the stock market doesn't go down. I'm not saying the real estate market isn't overvalued. We could make really great cases of both of those are coming, right? Nevertheless, the foundation of the house is in exceptional condition. This orange line, total deposits at US commercial banks. We kind of touched on this already, right? Just going absolutely vertical. Look at this. The loans can't even keep up. For the history of banking, loans basically match deposits because that's the way banks make money. Banks don't know who to give money to right now. There is no demand. And the only demand they've got is from junky, low credit borrowers, and they're not lending to them yet. So, and I keep saying yet because, you know, at some point, maybe the banks get greedy again and start lending to that group. We're going to want to watch that. Housing, right? We sort of know the perfect storm, 60-year low inventory, all-time low mortgage rates, not much building after the housing crisis. So there's a lack of supply, right? COVID's pushing people out of the cities like crazy. There's cash everywhere. This is really interesting. I mean, you know, more than 70% of all of the mortgages being issued right now in the first half of the year have gone to credit scores of 760 or higher. That's incredible. I mean, this shows you that the banks, they are not doing subprime lending yet. They're just not. Look at 05, 06, 07. What led us into the financial crisis was the precise opposite. It was the banks lending mostly, 75% of what they were lending was to under 760 credit scores, right? So I'm going to skip that one. The power of low interest rates. Most of us understand that. Here is the actual data, okay? So you take your principal and interest, your mortgage payment, your monthly mortgage payment, okay? And if you put 20% down and you have a median priced home in the United States and you do it on a 30-year fixed, right? What is your monthly payment? Okay, housing is way more expensive than '07, but the average monthly payment is just getting back to '07. And this is the beauty of those ultra low interest rates. It's really putting a lot of fuel behind home buyers, especially first-time home buyers, right? So if you have good credit, this is, even though the houses are more expensive than they were a decade ago, it's not costing you any more money. That's really incredible. Here we are 13, 14 years later, and our monthly payment's the same, even though the housing prices have doubled, right? So now this can't keep up. We really think we have seen a short-term top nationally in housing prices. We're really getting extended again where the average price of a home is really getting away from the average wage increase. So what's happening is we're going to run out of fuel. People are just not going to be able to buy houses. So they're going to stay where they are. And that's going to put a stall in the prices of housing, right? And this happens in any part of the cycle. And so we really think we're kind of seeing that weird tipping point. Another thing that leads us into this is that since the 70s, the University of Michigan has been collecting data around what consumers think. They literally have never had so many people so pessimistic about buying a house. So in the last 90 days, it's the sentiment around buying a house is abysmal. Nobody thinks it's a good time to buy a house, basically. We're also seeing mortgage apps continue to drop. We're seeing a slowing already. And we're seeing a huge explosion in the number of homes coming to market, right? Just again, in the past 60 to 90 days. So we think we're going to start seeing a real cooling here. This is even higher now. This is the number of homes that are listed for sale. And it had been coming down during COVID quite a bit. And now we're seeing a real ramp up in that. So, okay, so let's turn the table now. Let's talk about what do we worry about? That's all the great stuff that we're seeing in the economy and in earnings and in housing and things like that. Okay, so inflation, there is no way to get around it. The Federal Reserve wants us to think that there is no inflation or that all the inflation is temporary. And they always say transitory, right? But they're basically saying, no, it's temporary inflation, it's going back down. Okay, some of that's true, some of that is not true. And you know, there is real pain out there, right? You're trying to buy a used car, right? You're trying to go on vacation or rent a car. You're trying to buy gas. Some things that have gotten really, really difficult. So inflation, you know, is a real story out there. We've seen a lot of consistency in what corporate America is saying. That you know, corporate America is saying, hey, the backlogs are growing and we don't have inventory, right? We're having a hard time getting commodities. We're going to have to raise prices. And we're seeing a lot of supply chain bottlenecks still. It's still incredibly difficult to get semiconductor chips for cars, for example. You know, there's several million cars that are just waiting for semiconductors. It's made it incredibly difficult to buy a car. And so a lot of that is temporary, but nevertheless is going to weigh on profit margins, right? It's going to weigh on the cost of living. And so to a certain extent, we are going to see more inflation. We've gotten very used to 1% to 2% inflation per year. You know, we're quite confident we're going to continue to see well more than 3% inflation per year. That matters. And it matters when your interest rates are so low because you're not getting paid anything to have cash at the bank. You're not getting paid anything to have really conservative bond portfolio and things like that. So this is something that concerns us is that, you know, we definitely don't think we're going to see any hyperinflation, but the cost of goods are going to be higher. Wages aren't going to go back down. Housing prices probably aren't going to go back down anytime soon, right? Now, we are seeing some of that get cured, right? We're seeing lumber. This actually is getting back down in here. Lumber prices have really crashed back down. It's a great thing. You know, a saying amongst traders in New York is the best cure for high prices is high prices, right? So when commodities are very expensive, a lot of people want to start making commodities. And so you're going to start seeing more lumber on the market, more steel on the market and things like that. So we're going to see some of that get a little bit more tame. I'm going to skip over some of this here. I do want to point out, you know, we've kind of heard a lot about these headline inflation numbers here. I do want to show you something that's really interesting. Almost all of the inflation that we're seeing is coming out of just a couple of sectors here, like used cars, literally 40%. Think about this for a second. A few weeks ago, you heard that year over year, inflation was up 6%. That's what we heard here a few weeks ago. Okay, but 40% of that 6% is in used cars and trucks, right? That's a really, really big deal. You know, and another 24% was in rent, right? So in those two things right there, you've got 2/3 of the entire inflation picture sort of coming in that. You know, markets aren't cheap. There's no way to get around this. You know, in my business, you want to find value. As an investor, you're looking for something that's cheap. And there are things that are relatively inexpensive, but this is the S&P 500 as a whole. And when you know, we're near the top end of the range, right? So now that doesn't mean stocks are going to go down. What's actually happening right now is the market's starting to get even cheaper again. You know, in real time, we're back down in that range there, even since June 30th. In 6 weeks, earnings have been so strong and so much better than anticipated that the market's actually getting cheaper while it sits here. So what a lot of investors are sort of banking on is that earnings are going to continue to be strong. But we can't tease ourselves into any way thinking that the market is cheap. The reason this is important is not that you should be selling good growth assets. It's really more of a function of you have to expect some volatility. In any given year, the market averages, the stock market averages a 14% sell-off in any given year, right? We haven't had that for a while now, since COVID, right? So it's important to kind of be ready mentally to have these types of volatile environments and sell-offs. So if earnings start not coming in as good, the market might get a little bit disturbed and a little bit unhappy, right? Another thing that's kind of skewing the numbers, it's no secret to anybody that the really big companies in our country are driving a lot of GDP. Think about companies like Apple and Google and Facebook and Amazon. They're massive. And look at this for a second. The top 5 companies in the S&P 500, they are worth right at the moment about $4.1 trillion. Okay, that's the same as the bottom 282 companies in the S&P 500. Now remember, the S&P 500 companies are basically the 500 biggest companies in the United States. So these bottom 282 are huge companies. Delta Airlines is in that group. I mean, these are really big companies, right? But the top 5 are so big and they drive so much revenue and profit that they're worth the same amount of money as those 282. Here's how this kind of plays out. Right now, the top 10 stocks in the S&P 500 are trading at 30 times earnings. That's incredibly rich, right? Now, Google and Facebook and Microsoft and Apple, they are growing that fast. That's one of the reasons those stocks are so expensive. But if you look under the hood, the rest of the S&P 500 is not nearly as expensive. It's a lot closer to its 20-year average. And so it's not that every part of the market is really red hot. There are interesting opportunities within the market, but it's important to kind of understand some of these distinctions. By far, small businesses are reporting that their biggest headache is just finding employees. This is no secret. Everywhere you and I are going right now, we're seeing help wanted signs. We're also hearing these crazy stories about Taco Bell having to give people $500 just to come down and start their first day on the job, right? It's, now this is a complicated subject because a lot of people are still being paid a lot of money to sit home on their couch, a lot more than normal unemployment. The CARES Act stimulus that is still in effect is paying people somewhere between $15 and $30 an hour, depending on what state that they live in, right? Well, how does Taco Bell compete against 15 to 30 bucks an hour sitting at home playing video games? That's incredibly hard to compete with, right? So Washington is going to have to figure out how to fix this. And it's pretty clear we've got to start rolling back some of these stimulus programs because we're kind of really screwing a lot of our small businesses in our country at the same time. So this is a real headache that's got to get worked out here. Because it's not being worked out, you're seeing huge wage increases, right? I've seen it. Everybody I know that runs a business has seen it. You have to pay more to get employees right now. And finally, this is, one of my larger concerns, right? What happens when you have very low interest rates and it's very easy to get money, right? It's very easy to go to the bond market and borrow. What happens in that environment is there are companies that are borrowing that have no business even being in business, okay? These are the junk companies. We call them the zombie companies. They're the walking dead. Another way to put this is literally if that company can't borrow money this quarter, they're out of business because their profits don't keep up with how much their bills are, okay? Well, we are getting close to 20% now of the publicly traded companies are zombie companies. Well, look, in the 90s, this was mid-single digits, right? So as interest rates have worked their way lower and lower and lower, and money has gotten more plentiful, there's a recklessness out there. So right now, there's a solid 20% of the US stock market I wouldn't touch with a 10-foot pole. So at some point, that's going to come home to roost, right? When you go into a recession and it's not easy to get money and it's not easy to borrow, there is going to be a rash of bankruptcies. So you want to really be careful about the types of bond and bond funds you own because there's a lot of bad paper in the system. Do I think it's systemic? No. Do I think it's going to bring down our economy? No. But it does mandate that you're more picky and more careful about what you own, especially in bonds. In the old days, most of our lives, everyone that's on this call, you could buy a bond portfolio, sleep well at night, you just know it's safe. But in this environment, not only are you not getting any interest for owning bonds, but there's a lot of garbage in there. So really be diligent about understanding what you own. All right, I'm going to skip over some of this as well here, just in the interest of time. We've touched on a lot of these points already. Okay, so going forward, and kind of in summary here, earnings really good, stimulus everywhere, right? Cash everywhere. Interest rates are a huge tailwind. They're probably not going up anytime soon. If they go up a little bit. There is no situation where the Fed is going to allow interest rates to jump in a meaningful way. And they've already proven they'll print all the money that they need to make sure that doesn't happen, right? We talked about household. They look really, really good. And there's a lot of pent-up demand. I mean, just anecdotally, we meet with, hundreds of clients every quarter. There's a lot of people that would like to buy stuff, invest in stuff, and in some cases can't even find it right now, what to buy or what to invest in. And then, of course, what we're worried about is, things are somewhat expensive. Houses aren't cheap. You can make a case they're not super expensive either. But stocks aren't super cheap. Obviously, they're a little rich, right? So things are expensive. We're pricing in a lot of perfection. I never like that. So I'm kind of bracing for some volatility in the market. We've got to get this government stimulus under control with the higher wages. A lot of supply chain issues still that are very frustrating for a lot of industries and people. Tax rates are going to move higher. Hopefully here in the next 60 to 90 days, we're going to know a lot more about that. We're all starting to get frustrated that we're not getting visibility on these big tax law changes that are probably coming, right? And then the zombie companies and the junk debt. So where this leads us to is, number one, avoiding complacency. In my career, every time the markets are really good and really strong, people do dumb things. They make dumb investments, they go to sleep at the wheel, and then later they regret it. So I would strongly encourage you not to be complacent with your money. This is not the time. Obviously, we want to keep rebalancing our portfolio. When I used to be a floor trader on the New York Stock Exchange early in my career. I had a mentor that used to always say, sell when you can, not when you have to. So what that means is you want to make adjustments to your portfolio when times are good, not when the times are horrible, right? So if you need to, take some profits out of one area and kind of rebalance your portfolio, it's a great time to do that, right? We want to expect that volatility. Yeah, go ahead. Weston, do you have something to add? No? Okay. When we talk about barbelling our approach, this is what's kind of interesting. With interest rates being so low, it's kind of hard to have a lot of your portfolio in bonds because you're not making a lot of money in bonds. So we do this kind of tweak where we actually want to keep a little bit more even just in cash and money markets maybe than we normally would, even though we don't make a lot of money there. But we also don't want to sell our high quality growth assets. They might be a little bit expensive in the market, but people have been saying for 15 years that the market's expensive, right? And if you've been sitting on the sidelines waiting for things to get ultra cheap, you may never have invested, right? So what you do is you keep a little more liquidity and cash around, and you're ready for opportunities to invest, market accidents. You want to be a little bit opportunistic like that. So, and then, you might want to consider some alternatives in your portfolio, private credit structures and things like that. You can talk to the guys, about that. That's not right for everybody, but there are interesting situations more in private bonds. And I'm talking big liquid private companies. I'm not talking about some guy down the street you're loaning money to. There's interesting markets that the Fed can't touch there. And then obviously knowing what you own, this is a great time not being complacent by really understanding what's in your portfolio. And if the market drops 20% later this year, are you okay with what you own and how you're invested? That's a really an important thing to do when things are going good. David, Weston, I don't know if that's helpful, man, but that's sort of my prepared comments.
That was great.
You good?
Yeah, that was appreciate that, Kurt. That was some great information. Just a reminder to everybody, we're going to be we've recorded this, so we can send it out to you if you want to listen to this information again. And we're here to answer questions for everybody, and we'll be doing this again next quarter. So keep in touch, and we'll be discussing a lot of these points with you individually as we meet with you. So thank you again, Kurt. Appreciate all the great information, and we'll plan for this again in 3 months.
That's great. Happy to be here. Thanks, guys.